This might have been one of the most volatile weeks on Wall Street we've seen in a long time, and the headlines just keep coming. Trump just pulled smartphones and computers off the China tariff list, inflation data came in better than expected, but consumer sentiment? Not so much. We're breaking it all down, plus what would an iPhone actually cost if it were made in the US? Are we already in a recession? And is now the time to jump into Nvidia stock? We've got answers. Hit that like button, subscribe to the channel, and follow the show wherever you get your podcasts, Spotify, Apple, you name it. Now, let's get into it. Welcome back to Stonkcast, the market show for the average Joe. Whether you're a diamond-handed degenerate looking for the next 500% play, or a more conservative swing trader or investor, we've got you covered. We tackle the latest market news, give our 2 cents, and maybe, just maybe, help you make some money along the way. Good afternoon, everybody. It's your host, as always, Brandon Shar. We're back for another episode here on Stonkcast. And boy, oh boy, let's hop right into it. What a week we had in the markets last week. I've heard some people say it felt like a month's worth of trading in a matter of a week. And based off of some of the gains we had, I mean, you could say Wednesday we had a month's worth of gains in one day. It was a volatile week. And really, if you're an active trader in this environment, man, oh man, do you have to have a stomach of steel to navigate these markets. So let's hop right into it. Here's a recap as provided by CNBC. Dow jumped 600 points Friday, capping one of the most volatile weeks on Wall Street ever. The S&P 500 advanced 1.81%. The Dow Jones rose 1.56% and closed out the week just above 40,000. The NASDAQ composite climbed 2.06% to settle 16,724. Stocks took a leg higher Friday afternoon on comments from the White House that President Donald Trump is optimistic China will seek a deal with the U.S. It's been an insane week. I mean, heading into the week, obviously we were trying to digest the news we got the week prior regarding tariffs. And then Wednesday was when Trump announced that he was going to pause tariffs, do 10% floor. Stocks went soaring on that historic day. And it's just been a wild week. I mean, the overall markets ended the week up higher, if you can actually believe that. Taking a look at SPY here. I mean, this is the past week. We've had so much volatility, but as you can see on these daily candles, we've put in higher lows. Have we actually seen the bottom or not? I don't know. Time will tell. But the interesting thing here is the fact that despite all the volatility we've been having, this massive sell-off, quite potentially, capitulation, depending upon how you look at it. But this week, I mean, we've had these massive moves, but again, we're putting in higher lows here. So it's been an insane week this past week on Wall Street. And speaking of volatility, right, the CBOE volatility index known as the VIX, earlier in the week spiked above 50 before dropping to about 37 as of Friday afternoon. The Trump administration has opted for a universal tariff rate of 10% except for China. Goods from Beijing will see a rate of 145%, a White House official confirmed to CNBC on Thursday. So that was the week that we had in the stock market. It's been wild. It's been crazy. The VIX, I mean, is still pretty elevated, right? So it really seems like volatility is here for now, and it doesn't really seem like it's going really anywhere. But again, going back to what we're seeing on the chart, as far as the daily chart with SPY, for example, we are putting in higher lows, which makes me cautiously optimistic that maybe we have in fact seen the bottom. But again, I mean, we're in a news-driven environment right now. And so at any moment, news can come out and change the landscape. And speaking of news, we got some more of it here over the weekend. According to the BBC, President Donald Trump is kind of switching his plans on tariffs, at least as it relates to certain tech devices. So this is massive news as it relates to the NASDAQ, the Qs, right? The tech-heavy Qs. Trump exempts smartphones and computers from new tariffs. So U.S. President Donald Trump's administration has exempted smartphones, computers, and some other electronic devices from reciprocal tariffs, including the 125% levies imposed on Chinese imports. So this is massive, massive news for companies like Apple. You think about Nvidia, you think about Broadcom, you think about some of these other tech-heavy companies, right, that were facing some of these stiff tariffs that were put into place by Trump, especially those on China. And now it seems like he's taking a step back. In a notice, U.S. Customs and Border Patrol said that the goods would be excluded from Trump's 10% global tariff on most countries and the much larger Chinese import tax. It marks the first significant reprieve of any kind in Trump's tariffs on China, with one trade analyst describing it as a game changer scenario. So this is pretty big news, I would say. The reason being, we've had so much tension so far between the U.S. and China, and when it comes to these tariffs, it's been tit for tat, right, back and forth. And it really just seems like the tension has been building, right? And we really haven't seen either side concede. We haven't seen either side kind of back off, right? And so this was, I agree with this analyst. I think it's a game changer scenario because you have Trump, now backing off of these tech imports, right? Which is going to be massive. I mean, let's just talk Apple. Just Apple, not to include Nvidia and all these other companies. Let's just talk about Apple. The fact is, Apple imports from foreign countries quite a bit to the U.S. because of where, they're actually manufacturing their products. Something like 80%, I believe, comes into the U.S. This is massive news for companies such as, Apple. I'm sure Tim Cook is, sleeping a little bit easier tonight, especially after, the deal that Apple made, where they agreed to have one of the largest investments in the U.S., $500 billion. Right? So I think initially when, the tariffs came out, Tim Cook's probably thinking, what the hell? We said we were coming over here and now we got these tariffs. And so now Trump is kind of backing off. And so it really is putting Apple back in a good spot, right? And so as far as, what's going to come of this for the following week, if there's going to be any other exemptions, who knows? Who knows, right? The thing is, right now, you have to be on your toes with these reports. Trump is constantly changing the game. He's constantly dropping a new piece of information. He's, you have to be on top of it because news can drop at any minute that changes the dynamic, right? I mean, if we just take a look at the NASDAQ, we take a look at tech in general, when the tariffs initially dropped, it was probably one of the most areas of the market to be in because of that tariff impact. And now that Trump is backing off of it, right, with these exemptions, now all of a sudden, I feel like you're sitting on a ton of tech stocks that are insanely undervalued right now, if anything. Not to mention the fact that the U.S. and China might actually come still to a deal, which I believe they will anyways, but it just kind of adds more to the cautious, I guess, bullish approach to tech that you could say, right? So that's where we're at right now. So, Trump is putting this exemption, smartphones, computers, electronics, massive, massive news. And I'm sure China's thinking this is a step in the right direction as well. So what would have been the alternative, right? Let's say that, we would have had these massive tariffs still on these companies. I know there's been talks about Apple making iPhones in America. And, according to CNBC, I did find this article here, which is pretty interesting. Here's how much a made in the USA iPhone would cost. right? So defending its reciprocal tariffs, the White House this week said that President Donald Trump believes the U.S. has the workforce and the resources to build iPhones in the U.S. So that's interesting. Analysts who follow the company say the idea of an American-made iPhone is impossible at worst and highly expensive at best. One analyst estimates that on labor wages alone, so let's just talk labor wages, a US-made iPhone could cost 25% more than they do now. Another analyst pegged the price of a Stars and Stripes iPhone at $3,500. Folks, that's not cheap, right? I could go out and buy a used car for that right now. Sure, it might be a little crappy, right? The paint might be rusting off, but the point is, that's a very expensive iPhone compared to what we can get right now, which is, right around like $1,000, right? So the interesting thing that I noticed too about this article, it does mention that basically when we had President Barack Obama and we had the late Apple CEO Steve Jobs around, at one point in time, Obama had asked Steve Jobs, like, hey, what would it take to actually get, iPhones made in America? Could we make this happen? So this isn't really the first time a president has kind of thrown around this idea. Obama did. And basically, Steve Jobs at that time was very frank with President Obama and said, just quote, those jobs aren't coming back. That's it. So, that was Steve Jobs, visionary guy, the late Steve Jobs, right? That was his vision and really his opinion on bringing back jobs to the U.S. as it relates to Apple. It's so hard. It's so hard, right? And I don't really see Tim Cook having too much of a different view from Steve Jobs, I would imagine. If anything, it's probably gotten worse due to inflation. But defending its reciprocal tariffs, the White House this week said President Donald Trump believes the U.S. has the workforce and the resources to build iPhones in the U.S. Apple CEO Tim Cook, nor anybody else at the tech company have come out to back that claim. That is interesting, right? Because if Tim Cook felt very strongly about that opinion from President Trump, he would most definitely come out, I believe, and say something to back that up. Neither him nor anyone else in the company has done that. So I think that's interesting. I mean, when we just take a look at the iPhone 16 Pro, which is currently priced at $1,199, could it an increase of 25%? Is basically what you would be looking at for that phone if it was made in the US, just based off of labor costs alone, right? So that would make it a roughly $1,500 device. Wedbush's Dan Ives pegged $3,500 as the US iPhone's price shortly after last week's tariff announcement, estimating that Apple would need to spend $30 billion with a B over 3 years to move 10% of its supply chain to the US. So it's definitely an interesting idea, and would love for you to drop a comment. Let me know what your opinion is on this, if it's doable or not. But basically, it just seems like a lofty goal. Right now, it seems like we have moved so far in the way of global industrialization that to, move back one of the largest companies in the world, to the US to make iPhones. I mean, logistically would take a long time, right? But then separate from that, when we're just looking at the cost, just the cost, right? It's a lot. At the moment, Apple makes more than 80% of its products in China, right? 80%. Those products now receive 145% tax when they are imported into the US after Trump's tariffs went into effect this week. Obviously, this article is not accounting for the break that we just mentioned before, right? That Trump put on tech gear. So and it's an interesting conversation. Look, I love the idea of bringing back stuff to the U.S. I love it. But I, for one, don't want to pay $3,500 for an iPhone. So let me know what you think on that one. Moving along here, last week we did get some interesting data, economic data that is, and really we have conflicting stories right now based off of the data that we're getting right now. So let's take a look here. According to CBS News, U.S. consumer sentiment plunges to lowest since pandemic amid rising anxieties over tariffs. So consumer sentiment, for those who don't know, is basically a survey that comes out monthly that the University of Michigan does. And they're basically just asking various people, random people, a bunch of different questions on a survey just to kind of gauge how they feel about the economy, how they feel about the market, if they feel like we're moving in the right direction, the wrong direction. It's a very, very important metric because consumers drive a large part of the market, right? So according to this article by CBS News, consumer sentiment fell sharply in April, marking the fourth consecutive month of declines as an intensifying trade war fueled anxiety over American jobs and rising inflation. The University of Michigan's closely watched consumer sentiment index released Friday fell 11% to 50.8, the lowest since the depths of the pandemic. I don't want to just brush over that. That is massive. That is massive, right? The further fall in the University of Michigan Consumer Sentiment Index in April, along with the rise in both 1 and 5-year inflation expectations, suggests that the tariff-related fears, which have soured sentiment over the past couple of months, are here to stay, said Harry Chambers, assistant economist, capital economics, in a research note. So it wasn't good. It wasn't good, right? And I mean, when we look at this survey, right, it's done monthly. So you got to think about the people that are filling out this survey. They're checking their 401ks. We already talked about last episode. We're in a period where 401k activity right now is the most active it's been since the pandemic. So of course you have people seeing the decline in their retirement accounts and getting nervous. Not to mention, if you just take a look at a chart over the past month, it hasn't been pretty. So I'm not surprised at all that we have this low number. In fact, it's what I expected. But again, I think that what's important to keep in mind here when we're looking at something like Michigan consumer sentiment, it's about the sentiment, right? So it needs to be cross-checked with actual facts, right? This is what a group of people believe is going to happen with the market. It's the level of confidence they have in the market. And again, it's based off consumers. Consumers are a huge part of the market, as I said earlier. So I'm not trying to downplay it, but I think it needs to be checked against actual numbers of what is really going on in the market right now. And that kind of leads me into the conflicting data that we got towards the end of this past week. So you have consumer sentiment, which is low, right? But then in addition to that, we did get some reports towards the end of the week. We got CPI, right? This is an interesting one. According to CNBC, inflation rate eases to 2.4% in March, lower than expected, core at 4-year low. So on the one hand, we have consumer sentiment saying the sky is falling. But when we take a look at the inflation data that we're getting, right, it looks good. The consumer price index fell a seasonally adjusted 0.1% in March, putting the 12-month inflation rate at 2.4%, down, right, from 2.8% in February. Excluding food and energy, so-called core inflation ran at a 2.8% annual rate, having increased 0.1% for the month. That was the lowest rate for core inflation since March 2021. So this seems like a pretty good thing to me. The fact that we're starting to see inflation drop is huge, in my opinion. And while I don't like a negative consumer sentiment report, yeah, that sucks, but I get it given what we've seen the past, month. The data is telling us, at least according to inflation, and keep in mind that we did get PPI data on Friday as well. That's the producer price index, and that also fell, right? So you have consumer inflation, you have producer inflation falling, and this is great news for Wall Street. It's great news for the economy. It's great news for the Fed. It kind of puts the Fed in a position where they don't feel overly pressured to kind of force additional rate cuts that maybe they didn't have planned for the year. So Wall Street had been looking for headline inflation at 2.6% and core at 3%, according to the Dow Jones consensus. And here's a great chart here provided by CNBC of the U.S. Consumer Price Index. If we take a look at it, we had this massive peak of 9% inflation kind of mid 2022. And ever since then, it's been coming down. The Fed's been trying to do their job. And as you can see right now, I mean, we're hitting new lows. So that is great. I mean, that's great news. And that's something that we want to continue to see as we continue each month to get these inflation reports. That's one thing the Fed is definitely paying attention to. It's not currently their leading indicator as it relates to rate cuts, but it's still very, very important. And so that kind of leads me into my next segment here, which is, are we already in a recession? Because based off of what I just shared with you, right, you could have some very different opinions, right? If you're looking at consumer sentiment, I would say it's probably safe to say a lot of the people who took that survey think that we're either in a recession or we're headed to one, right? If you're looking at that inflation data and you take away the consumer sentiment portion, things are looking pretty good. It seems like the market is actually holding up. And not to mention the fact that when we take a look at initial unemployment, which came in this past week, it came in as expected. It wasn't super heavy. It was about as expected. So it appears right now the labor market is holding up. It appears that inflation is coming down. It's cooling off. And those are all, great things, right? According to this article that I found on Yahoo Finance, BlackRock's Fink says most CEOs tell him we are probably in a recession right now. This is interesting. So, CEO Larry Fink of BlackRock on Monday said stocks could go down another 20%, and that most CEOs I talked to would say we are probably in a recession right now, is what he said. The U.S. economy, he added during an appearance at the Economic Club of New York, is, quote, weakening as we speak. So that's concerning, right? When you've got one of the largest companies in the world, the CEO of that company being BlackRock, essentially saying that, look, all the CEOs that I'm talking to right now think we're, probably already in a recession, right? That is concerning. The boss of the world's largest money manager tried to inject some optimism amid his warnings, especially for investors with a long time horizon. He said, quote, some stocks are down over 30%, 40% of their high water marks just from January. Fink said, but I would say in the long run, this is more of a buying opportunity. That doesn't mean we can't fall another 20% from here too, but I do believe over the long run, the vitality of the United States will persist. So he tried to kind of sprinkle some optimism in there. But according to him, he's pretty well convinced that we may be heading for a recession, right? Now, look, I'm not an economist. This show is primarily for traders, right? Those actively involved in the markets. But based off of what we're seeing from inflation and unemployment, that type of data right now does not seem to be breaking. Now, there may be some minor cracks in the overall system that are beginning to show a little bit. But I just personally, I don't think we're there yet. I don't think it's time to cry that the sky is falling. Let me know what you think. But right now, I think based off of inflation numbers, primarily, I think we're headed in the right direction. And things are kind of getting clouded right now by the tariffs, of course. But that's basically what I'm seeing right now. I think that it's important to have a balanced approach. It's important to hear opinions of others that don't share your same opinion, especially when you're dealing with the market. If I'm thinking a stock is going to go up, I want to hear the argument for why it's going to go down as well, right? Because it's important to be balanced. But as of right now, it doesn't really seem like we're there yet. But I'm also not the CEO of BlackRock, so take my opinion for what it's worth. Now, this was an interesting diagram that I found online, just to kind of go to the point of, when we have these periods in history where we have a major event happening, right? Like we had COVID in 2020. Right now, it's the tariff scare is what I'm going to call it. When we have these kind of situations and the market sells off inevitably, right? The market continues up. So take a look at this. Don't stop investing. There are always reasons to not invest, but the S&P 500 has returned 10% per year on average since 1950. I mean, this is pretty incredible. It's easy in the moment to kind of freak out, but you got to zoom out. And this is a great example. JFK killed, you had the Vietnam War, we had stagflation, 18% mortgage rate, Soviet Union collapse, Y2K, September 11th, housing crisis. I mean, we had so much going on here. And despite all of this, the S&P continues to return 10% per year on average since 1950. So I think that's pretty great. I think if you're a long-term investor, look, we may have seen the bottom here, right? On SPY, 481.80, right? We closed Friday at 533.94. So if we did in fact see the bottom, then this is obviously the time to hop in if you are a long-term investor. And really that's the key word. And again, for my active traders out there, man, more power to you. Because it has been super volatile, really hard to gauge, really hard to read anything. And especially with the headlines as they keep coming in, any moment something can drop. But real quick, I want to, just from a technical analysis standpoint, kind of point out something here, because while we may have this bottom coming in, we also have one of the most bearish signs that you can get, which is the death cross. For those who don't know what a death cross is, it's when the 50 simple moving average crosses below the 200-day moving average. The 50 is represented on my chart here by this white line, the 200 being the yellow. And as you can tell, it looks inevitable that, we're going to get a death cross here. And if we just take a look at IWM, for example, this already had a death cross, right? And if we take a look at the Qs are in the same boat as SPY, getting awfully, awfully close to a death cross. Looks like it's going to happen there. So that is a very, very bearish signal. And just to give you the polar opposite of that would be the golden cross, which would be where the 50 crosses above the 200. But right now we're looking at death crosses on the major indices, right? Which is not great. Not great at all. But it could just be, it could be a bit of a fake out. Again, we're in a headline driven environment. So any kind of bullish news that comes out, if there's a China US deal, it could kind of, in a sense, override some of the technicals that we're seeing. But speaking about investing, right? Speaking about stocks that, it might be a good time to kind of check out. I would like to highlight a couple of them, one of which being Nvidia, right? Especially being in the tech space with the news that we covered earlier with Trump and the exemptions. This, I believe, is a company that is currently undervalued, right? And this too, right? This too had a death cross, right? So technically, it is a bit bearish right now. But man, if you are a long-term investor, given this dip that we've had, Buffett always says, buy the fear, sell the greed. Well, guess what we have right now, folks? We have a lot of fear. If you're an investor, this is a prime time, in my opinion, not financial advice to be clear. But this would be the time that I would be looking to buy up some blue chip stocks. I think now is the time for that. As far as some information, I guess you could say, to kind of back up that theory or opinion that I have. I found this interesting article, Yahoo Finance, the best $1 trillion stocks to buy now, according to Wall Street. Only a handful of U.S. companies currently have a market value exceeding $1 trillion. They are listed below in descending order based on the upside or downside implied by the median 12-month target price set by Wall Street analysts. So first and foremost, like I was just saying, Nvidia, it's currently worth $2.7 trillion. The median target price of $175 per share implies a 58% upside from its current share price of $111. So, at least according to Wall Street analysts, right? Given the value that this company has, and we all know this company has value. It's one of the biggest companies Yeah, it still has a lot of upside according to them. I mean, we had a high of 153. They're looking at 175. We're at, 110 right now. So a lot of upside on that. Here's another one. Amazon, currently worth 2 trillion. The median target price of 266 per share implies a 44% upside from the current share price. Meta Platforms, currently worth 1.3, implied upside of 38% based off of median target price of 750. It's currently trading at 544. You have a lot of things that are on sale right now, folks. Alphabet, currently worth 1.9 trillion. The median target price of 210 per share implies 34% upside. Microsoft, 29% upside. Apple, 26% upside. You get the idea here. And kind of interesting, actually, Berkshire Hathaway, the only one on here that has an implied downside of 7%, which is kind of interesting to me because it seems like Berkshire's been the only company that's really been thriving in this volatile environment. Every time I look at it, seems like it just continues to go up. Warren Buffett is the GOAT, in my opinion. So, but yeah, these are definitely stocks to keep an eye on. Listen, all right, buy the fear. Buy the fear. I mean, that's as simple as I can put it. We're in an environment right now where a lot of things are on discount. A lot of things are undervalued, and that's when you want to get in. From a human psychology standpoint, when it comes to the markets, we have a tendency to buy things when they're going up, catching FOMO, and that's just the wrong time, folks. It's the wrong time. I'm guilty of it, just like most of us. When you want to buy is really when you don't want to buy, right? When your emotions are telling you, things are going down, this looks bad. When you get that feeling in your stomach, right? That's when a lot of the pros are stepping in and putting down money to buy up these companies. So as far as the Magnificent Seven, as far as a lot of these blue chip companies, I really don't see a reason right now why they would not be good buys, given, some of the continued headlines that we get. I mean, the tech exemption from Trump is a prime example. That can happen tomorrow. We could also get some bearish news tomorrow on tariffs. I mean, again, it's volatile. But if you're thinking long term, I don't think you should really concern yourself too much with the short term. So those are my thoughts. That's my market update for you. Let's take a look at the week ahead real quick as far as economic data. Let's take a look and see what we got going on. Obviously, last week we had unemployment reports. We had inflation, as we talked about earlier. This week, keep in mind, we do have a shortened trading week. Friday being Good Friday, the markets will be closed. So we got 4 days this week. So if you got short-dated options, be mindful of that. We got a Fed speaker, Waller, on Monday at 1 p.m. A couple other Fed speakers. Not a whole lot going on early in the week as far as economic data. Wednesday, April 16th, however, we do have core retail sales coming out at 8:30. That's going to be pretty big. Previous was 0.3%. The forecast is 0.4%. So keep an eye on that. Again, going back to the idea that the consumer is a big part of this market, we want to pay attention to retail sales. So that's coming in on Wednesday. In addition to that, we get crude oil inventories at 10:30. And then Daddy Powell, Mr. Fed Chair Jerome Powell, is speaking on Wednesday at 1:15 p.m. That's going to be very, very important to pay attention to see what Powell says. Everyone's trying to get a read on what him and the Fed might do. They had that closed door meeting last Monday. Are they going to lower rates? What are they going to do? So definitely want to pay attention to that. Anytime Jerome speaks, he moves markets similar to Trump. Thursday, initial jobless claims coming out at 8:30. That's going to be a big one. And then you get the Philadelphia Fed Manufacturing Index coming out at 8:30 as well. And that's about it. There's some other stuff in there, but that's some of the more important items. I would say the more volatile items that you want to pay attention to. So I believe that's about it. We will be back on Wednesday for a midweek check-in. Kind of see where we're at, see how the beginning of the week looks. As far as futures opening up tonight, I'm expecting a very, very bullish opening based upon the Trump news with the tech exemptions that he dropped over the weekend. Drop a comment. Let me know what you're thinking, what you're keeping your eyes on as far as trading or investing for that matter. And as always, please like and subscribe. And remember, plan the trade and trade the plan. Have a good night, everyone.